Let me start with you, Kristina. Is the sky falling?
The sky is not falling, but markets are adjusting to very changing circumstances. If I said that right, very changed circumstances. What we are doing is seeing an adjustment that is very, very significant because what the Fed and other central banks are doing, as you mentioned in the intro, is very, very significant. This is the analogy I'd use. If you're lactose intolerant, you have a half a cup of milk, it's a little painful. If you have a gallon of milk, it's extraordinarily painful for a few hours. And we just drank a gallon of milk and we're lactose intolerant.
Well, to continue that analogy a little bit, Tracy, we were told we were going to have to drink the gallon of milk. Why didn't we believe it?
This is what I don't get. So I think one of the reasons this week is so significant is because it really seems to me like investors have woken up to this pain messaging that Jerome Powell and other Fed members have been trying to transmit for many, many months now. I mean, we even had the Minneapolis Fed president, Neil Kashkari, come on and say, pretty much explicitly, I would like to see stocks lower. I was happy when stocks fell after Jackson Hole. Tighter monetary policy works through financial conditions. They need financial conditions to get tighter. But for some reason, the market has been reluctant to take on that messaging. I really think this week is sort of the moment that everyone woke up. Now, I'm a journalist and I'm not allowed to have official opinions, but I would say that anyone who still believes in the soft landing prospects, they need to be getting worried at this point. The path to a soft landing seems narrower and narrower, almost by Fed design.
And as a journalist, you've talked to a lot of people who are saying something just like that. You're being a good reporting there. But Kristina, what did you want to say?
I was just going to say, in fairness, the Fed didn't think it was going where it's going. It has its view of inflation has evolved dramatically. If we go back to the dot plot from December of 2021, the median expected Fed funds rate for the end of 22 was 0.9%. Now we're at 4.4%. So we've seen the Fed do an incredible turnabout in terms of its views on inflation. So that's why I think we had the market reaction we did. Not everyone expected it because we didn't exactly know what the Fed was thinking.
The whole purpose here, Tracy, obviously is to get our arms around inflation, which we have not had. We lost control of it without a doubt. I think the Fed would admit that as well. What is that going to take? What does your reporting tell you about going to take? And do we believe the Fed is up to the task? Because as Kristina just said, they've had to change their theory here.
Well, I think you are starting to see some signs of deceleration, and I hate to do the sort of line-by-line CPI analysis. It's probably boring for everyone involved, but there are some technical changes coming up to healthcare, for instance, that are expected to take some of the acceleration out of the inflation index. But I think the big issue here, going back to the Fed and what Kristina was saying, is they've misjudged the lag between rate changes and the impact on the economy. And they misjudged that going into the crisis or coming out of the immediate pandemic, the worst of the pandemic in March of 2020. I mean, if you look at early 2021, CPI was still at 1.7%. You can kind of see why they were a little bit sanguine about what was happening. Now they're raising rates, and they seem very emphatic about doing it as quickly as possible, which begs the question of whether or not they're going to misjudge the lag this time around as well.
So, Kristina, the story here in the United States is dramatic enough, but we're not in a vacuum. We see some form of tightening happening pretty much around the world, maybe with the exception of Japan and China. But let's talk about what other places are doing. The UK had an extraordinary development this week. They upped their interest rate at the same time. They had a new government come in and say, let's stimulate with cutting a lot of taxes.
Well, that is certainly adding to the complexity of the situation. Monetary policy is a blunt instrument. The best we can do is try to calibrate it, but it becomes that much harder when you have other impulses. And so it's a difficult situation. Now, I will say that this kind of environment that we're in is rather unique. The World Bank came out last week with a big warning about how this is the most synchronized tightening among central banks that we've seen in 5 decades. And that was, of course, a stark warning about what could happen. And we're seeing it play out, certainly in markets.
I'm not sure if the bond markets get a vote, but if they got a vote with respect to the UK, they voted pretty firmly on Friday. What happened with the gilts? It was pretty extraordinary.
It was absolutely extraordinary, and I think the biggest impact we've ever seen to a mini budget proposal like this. And what is really extraordinary is to see the UK government basically unveiling the most regressive of tax cuts in an effort to boost growth at a time when the Bank of England is clearly worried about inflation. And the really worrying thing about today's price action was when we saw the currency fall while bond yields are spiking. That is a classic hallmark of emerging market crises. And we saw a bunch of analysts and investors make exactly that point. It's kind of crazy that we're treating a developed market economy with a very, very important financial center like an emerging market. And the big concern now is it passes the buck or passes the baton on to the Bank of England to try to handle this. And then you start getting worries about fiscal dominance, which again is a very EM thing to be saying about one of the world's most advanced economies.
So, Kristina, the one winner, I'm not sure if it's winning, is the dollar. I mean, the dollar is just on a tear, and it just keeps going. Japan tried to intervene a bit. Maybe it helped a little bit at the moment. Not sure on the long term it will. What does the strength of the dollar mean for the economy in the United States and elsewhere?
Well, it's a good thing for consumers in terms of purchasing goods from outside the U.S. It's great for tourism of U.S. Citizens abroad, but it can be very, very problematic for multinational companies, the U.S. companies that derive at least part of their revenues outside the U.S. So we've got a lot, there's a lot at stake with a very strong dollar. And of course, there are implications for all the other economies as well. So it's a difficult time, but not surprising given the kind of dynamics we're seeing and the kind of factors that have driven the U.S. dollar higher.
Tracy, any impetus to try to get it under control? I mean, this was the 37th anniversary on Thursday of this week of the Plaza Accord.
Yeah.
Any notion we might try that again?
It's a little bit different this time around. I think the dollar going into the Plaza Accord had appreciated by something like 40%. It's 10% now. Slightly different conditions. But that said, I really think the dollar is kind of driving everything at the moment. And, you know, the market has taken on this mantra of the Fed is going to hike until something breaks. We should probably caveat that by saying until something American breaks, because we're already seeing things shatter around the world, right? Japan coming in to intervene in its currency for the first time since 1998. What happened to UK and sterling today? Euro going further under parity with the dollar. These are signs of the dollar coming in like a wrecking ball. The dollar is the weapon of higher interest rates in the US, and it's problematic at a time when much of the world is experiencing, for instance, an energy crisis, and a lot of those commodities are invoiced in dollars. It's difficult.
But ironically, it dampens inflation in the United States, the stronger dollar.
It's,
right?
yeah, you know, it's a privileged position to be in the U.S. and to have the world's global currency. But it is difficult for investors. I mean, again, to this point of the dollar kind of ruling everything. If you think back to inflation hedges earlier this year, it was mostly commodities. And the strong dollar has taken a lot of the air out of commodities now, and it's making it difficult for investors to hedge.